Over the past few months, the Bombay Stock Exchange Sensex has moved down from 62,000 points to 57,000 points and then moved back almost to the same level of 62,000. Now what happened to investors is, let's say an investor held 1 crore of equity mutual funds at 62,000 points. It went down to 57 and he found his portfolio valued at about 85 lakhs. He had lost 15 lakhs of hard-earned money at that point in time. And when it came back up to somewhere close to 62 again, now the thought in his mind is, should I just book some profits and keep some money away rather than lose it again when the market goes down? This is a classical dilemma that every investor faces, my friend. The question that runs in everybody's mind who has a large portfolio is, should I book profits every time the market seems up and in a volatile state? If all your monies are held in equity mutual fund and nowhere else, then it makes sense to keep repeatedly booking profits every time the stock market hits a new high. Maybe you set yourself a level of 15%. So every time you have a 15% absolute return on your portfolio, you take that 15% out and use it in the way you want to. So that's a very, very smart way to do in the absence of anything else. But there is a problem, especially when it comes to mutual funds. When you remove even 1 rupee out of a mutual fund, it is not the gain that you're removing, but every rupee comes with an embedded cost of profit and the principal amount, both in it. So let's say as an example, somebody had invested 10 lakhs in a mutual fund, in an equity mutual fund. And the portfolio grew at the end of 1 year to 12 lakhs, giving a profit of 2 lakhs to the gentleman. Now let's say after 365 days, since there is long-term capital gains and no load, he would like to get the profit out. So he theoretically wants to take that 2 lakhs of profit. But in reality, what happens is when he draws the 2 lakhs out, he gets the 2 lakhs embedded with both the profit and the principal, which means that the 2 lakhs worth of current value means he's actually pulling out 1.7 lakhs worth of the invested value, and therefore the overall portfolio goes down by this extent. So 12 becomes 10 investment value becomes 8.3 or thereabouts. Therefore it continues to show a profit. Now that's really the issue with mutual funds, because in most other cases when you pull out the profit, the portfolio should show zero profit. In mutual fund, unfortunately, it will never show zero profit unless you redeem the entire 12 lakhs. Now, it's not so feasible to redeem your entire investment to book profits because there are multiple issues to consider. One is there is an entry cost and an exit cost. Every time you exit a mutual fund, you have load structures, you have capital gain issues. Plus, every time you enter, you have a stamp duty that you need to incur. So, if you want to not get into all these aspects, then one needs to be very careful about pulling out all the investments all the time and redeploying it. Second, there is also the cost of re-entry. Let's say you pulled out all your investment today. It's never guaranteed that you will get to invest at the same level or at a lesser level. It's also likely that you may enter at a much higher level, which is then becomes a slightly higher risk. You're actually pulled out your investment at a lower level and reinvesting. Not a very smart way of doing. Is there a better way of therefore booking profits? Or as a long-term investor, should I not book profits at all? The answer is no for both. There is definitely a better way, and that way can also help you objectively redeploy your money. And that's what we call an strategic asset allocation plan. Now, what do we mean by strategic asset allocation plan? Let's say there is an investor who starts investing he determines based on his risk appetite. Let's say he's a 50-year-old gentleman who wants to take a little risk but wants to play it balanced. Then he would put 50% of his money in equity, 40% in debt instruments, and maybe a 10% in commodities like gold and silver and so on and so forth. So this is the portfolio that he starts with. Of 100% is divided 50, 40, and 10. And let's say over a period of time, the equity is done really, really well and moved from 50 to 60. Debt is also moved and done a bit. And then the gold, for whatever reason, has done badly or not done well. It's changed that number. Then you redistribute that portfolio. You make sure that that entire portfolio of whatever is the value that's performed goes back to the same 50, 40, and a 10% allocation. Now this is called a strategic allocation. The advantage of strategic allocation is that it aligns to your risk appetite. So you're not doing anything that's outside of your risk appetite. You're doing what is within your risk appetite. Second, it naturally provides for pulling out monies from assets that have appreciated well and moving that money. In this example, let's say equity is done exceptionally well. We are actually moving money from equity into gold, which is actually not done really well. And if in another scenario, gold has done well and equity has not done well, we will reverse this because the asset allocation percentages are ideal. So my ask would be that never really exit an asset class completely. That would be a big risk. Rather, follow the strategic asset allocation plan wherein you determine the amount of money that you want to stay with. And when you review this ever so often or when a big event happens, you will find that you need to rebalance it to that level. And when you rebalance it, automatically you're booking a certain amount of profits and thereby getting smarter. Different studies have done this work over a long period of time. And if you stay true to the asset allocation and rebalancing very, very objectively, it has generated a huge amount of wealth to investors in the long run. So in conclusion, I would say instead of merely looking at subjectively booking profits at various points in time, whenever the market goes up and whenever markets goes down and being this thing about it, the strategic asset allocation could be a good way of rebalancing portfolios so that in the long run, you create a fair amount of wealth for yourself and your money is always at work, whether it is in equity, debt, or gold, as the case may be.